Hey everybody, and welcome to the Plant Stock channel. Hope you guys are doing good. Today we're going to focus on TTCF's latest earnings results for their Q4 and 2021. Sorry, there was a mistake with the time. I wrote in my Discord and the different areas that we're going to start today at 10 a.m. Eastern time. And the problem is that when was it in the U.S. when you changed the time? Was
Daylight
it?
savings.
Yeah, was it like a week or 2 weeks ago or something?
It was. Yeah, exactly.
Yeah, and that's the reason I was late now, because I was thinking we were going to start in another 20 minutes or something, and we haven't changed that in Sweden yet, so that's why we're a little off on the time here, guys. So, all right, guys, but welcome everybody. And I thought this is Mayur Thaker for you who don't know him, because I don't think the Tattoo Chef crowd knows you as well. So maybe you can just quickly introduce yourself.
Sure. So I am an analyst. I work for a company called Zacks Investment Research, and we make software that's used by portfolio managers and analysts at professional asset management firms. And so I have experience working with analysts and asset managers on Wall Street.
Right. Right. So, and we've been doing this for quite some time. We've been talking now for, well, I had videos at least once a week now for, I don't know, 5, 6, 7 weeks or something. And we've focused on Beyond Meat and Oatly. And then we talked the other day, a few weeks ago, that should we maybe, talk about Tattoo Chef from now and then. And we thought, well, this would be a perfect time with their earnings call yesterday and their reports. And before we just move on, I just want to highlight that, disclose that this, whatever we talk about here, this is just our own opinions. These are not financial advice, just two friends who are interested in stocks and plant-based stocks especially. So just keep that in mind, guys. But again, so I thought, I just want to tell you guys also, when it comes to Mayur, that this hasn't been one of your focus stocks, right? And I thought I wanted to tell you that, guys, that he might not have the same background that as many of us who've been following the stocks now for about 1.5 years, since his SPAC days. And I'm thinking that could be a good thing, right? Because there's been, like a lot of stocks out there, by a lot of us YouTubers, been a lot of hype regarding different stocks, but also regarding Tattoo Chef especially. So I thought someone who's maybe not been part of that dynamic, that sphere, could be good to have some nuanced eyes, just looking at the numbers and then just getting a sense, getting a feel for the company now. So, and my understanding is that you've known about the company, right?
Yeah.
Yeah.
Yeah, I've definitely known the company, not having followed them financially, but just seeing their products in stores and having most of their products as well. So
Yeah, exactly. So again, yeah, they had their earnings call yesterday, and is that something you would want to just take us through quickly what you saw, and then go into some details?
yeah, sure. So growth was about 32% quarter over same quarter a year ago, bringing it up to about $52.3 million. Overall growth was pretty strong for 2021, versus 2020 of roughly 42% growth year over year, 43%. So pretty good growth, but their growth has slowed slightly, especially if you look at they have basically two types of categories of products. One is their branded products, and the other is their white labeled products, or private label. And their branded products are really where everybody's focused on, because that's where the margins are. So this being a business, not a charity, so with investors, so we're all focused on where profitability is best. So the branded side of things kind of slowed year over year. So that was something that was kind of a red flag, or not a red flag, but more of a disappointment for the quarter, I think. Especially because this is a company that, relatively speaking, is starting from a very small base. right? So, we have, companies that, grow at 50, 60% because they're starting from a very small base. And, Tattooed Chef is not quite even there. Growth has kind of slowed down to about 43% year over year. And specifically within the branded segment, the growth has been even less than that. So, a big thing about companies like Tattooed Chef and others who are in a similar position where there's a lot of excitement, a lot of, optimism about the future and, high growth potential. Revenue growth is everything for companies like Tattooed Chef. Execution is everything. Because remember, investors are not focused on profitability right now. They're giving these companies a pass because they are so early in their growth phase that right now it makes sense for them to just invest in growth, invest in execution, invest in making sure that customers are getting their products and having the best experience possible. So shares of Tattooed Chef and others like that are highly dependent on executing to deliver strong revenue growth. And right now it's starting from a small base. Even though we're talking about revenue in the tens of millions per quarter, in the food industry that's very small. So to have to get attention from investors, you want to see and continue to show eye-popping revenue growth.
Yeah.
And without that, this is just another food company in my view. This is just my personal humble opinion. Could be wrong, but right now, everything that I've seen in the numbers and what they discussed on the call tells me that this is basically just another food company, one out of dozens and dozens.
Right. So
what separates them is the fact that they're plant-based or vegetarian, which is great because I'm vegan, so I love that. I'd be happy to buy their products and have, and I love them. But I don't see anything from what I heard on the call that sets them apart, right? What is it that they're going after? What is that total addressable market that they're going after? And I don't see there being a significant thing about them that makes them unique from everyone else.
No, but because I guess what they've been talking about, we know that they're a frozen section company. They've been focused on frozen food now for a couple of years. That's been their expertise, and they've been doing well so far. What I understood, they moved into several larger retails like Target, which is what I understand really big in the US, right? And they've been outperforming other frozen companies basically in that whole section, and just being there for I think about a year now, since March last year. And they have several products there that's basically considered the best, even better than Lean Cuisine. That's actually existed, I don't know, for 30, 40, 50 years. I remember seeing commercials about Lean Cuisine when I was a kid. And I'm really old. So I think that's quite impressive that they could actually move into that already and do that and grow that fast, considering that I think by the end of 2020, they were at about, I think it was around 4,000 stores. And in another year, they grew about 10,000 stores. So 14,000 stores, which I think is impressive in many ways. But again, I haven't really looked at the history of the typical food companies, and I don't know what would be normal in sales. I mean, I know if we go look at the really large ones like Conagra or Tyson Foods, then we're talking about billions, of course, in food. I mean, I think it's between 20 to 40 billion in sales per year. And I know that a lot of people out there, especially Jeremy from Financial Education, he's kind of like talking about the possibilities that we could see this becoming something like that. So that at the very least, that we could see sales of like 10, 15, 20 billion in maybe 10 years from now. So, and obviously that's hard to know now. And considering the margin, they've had issues with margin. I think, what was it around now? It was.
It went all the way down to 2% for Q4.
Yeah, for Q4. But for the whole year, it was about 10, 12%.
Yes. Yeah.
Yeah.
So it was about 10.4%.
Yeah. So, and the warning sign here, obviously, is also that, according to them, in the earnings call, and it's stated in the report, is that they are expecting about 10 to 12% for the whole of 2022 as well.
Right.
But obviously, there were a lot of reasons for that. But that they're expanding and putting in a lot of money when it comes to commercial. About 30 million, I think. So if we take a look at the, do you have the screen? You want to share the screen when it comes to their financials?
Yeah. Yeah. Let's look at that. So that's you know, it's another thing that just gives me some pause. Now the thing is that when they said on the call that these are kind of short-term issues that they're working through, that's fine, especially because of the nature of what caused that gross profit margin to decline. You can see right here in this paragraph under the fourth quarter results, gross profit declined to 1.1 million or 2.1% of revenue. This is because of a promotional allowance accrual. So, they didn't talk about this too much in further detail on the call. They just chalked it up to what they call a promotional allowance accrual.
Yeah.
I'm thinking that has something to do with stock-based compensation. I could be wrong about that, but I think that's what it sounded like to me. So, it looks like it's not going to be something that is going to haunt them forever. But it is expected to continue in Q1 as well. And that's what's going to weigh on their full year gross margins. However, this might be a non-cash expense. So that's important too, is for, especially for companies like Tattooed Chef and even Beyond Meat and Oatly. These are cash burning companies. So how much cash you're consuming is of paramount importance.
Yeah.
And I think that this cost that they are recognizing in Q4, as well as into 2022, is a non-cash expense. And that's why I think it has something to do with stock-based compensation.
All right.
That's just my guess, but we will see. But if that's the case, then their cash burn won't be as bad as it sounds.
No.
So that's a good thing to see there.
Yeah.
I think the bigger thing that people are going to be worried about is not that allowance, promotional allowance, but the other part of why gross profits declined or margins declined, which is higher freight and container costs. Right?
Yeah.
We all see this happening throughout every company that we're following. Everyone is reporting high transportation and logistics costs. This is why it's so important to have manufacturing locally, so that you're not having to ship very long distances. And so they are, working on that. They did, make 2 acquisitions, this New Mexico food distributors and another Belmont Confections.
Yeah.
So that's, good to see as well in terms of, them, playing out their strategic, overall strategy. But just like what we heard from Beyond Meat and Oatly, they also are relying on co-packing and co-manufacturing as well. So that's, again, hitting, gross margins in addition to higher logistics costs, higher, fuel and shipping costs. So we don't know how long this is going to last.
But isn't that a bit weird? Because I might be wrong, but if you are, they talk a lot about that they're a fully vertically integrated business. Would it be normal then to actually rely on co-manufacturers?
I think that's where they want to go.
Yeah.
But they're not yet there.
No.
They want to be vertically integrated.
Yeah.
So there's actually one part of the call that I found the most interesting. So the numbers are, the margins are very bad, and the growth is good overall, but the growth of their branded products is not, that was a big disappointment.
Yeah, it's slowing down.
It slowed down, yeah. So there's one part of the call that I found fascinating, which was that they talked about, investing roughly $20 million on automation equipment.
Yeah.
So, and an analyst asked about that specifically in the Q&A section, and they said that she mentioned that you could in their production line, for example, in their Mexican food that they make, there is a potential that they could reduce the number of workers on that line by, I think she mentioned 6 to 8 workers.
Right.
And double the output of that manufacturing line, of that assembly line. So this is where I think things get interesting. So remember, from the consumer point of view, yeah, their products are great. They're very tasty. I love them. But if one day they don't make, XYZ product, I'm not going to be, up in arms about it. I'm just going to go to somebody else. And if someone else comes out with a cheaper product, I'll probably just go to them. Like, I
Right.
don't, from the consumer standpoint, I don't see them as, standing out over any other plant-based frozen foods, maker out there. And there's
Right.
so many of them now. So what Tattooed Chef needs to do, in my opinion, to be a standout is to excel in manufacturing and distribution. If they can get better gross margins than every other, food maker out there, that would be a reason to own their shares. If they can get, phenomenal growth, that would be a reason to own their shares. But I just don't see their product standing out as much from other products. I don't see enough product differentiation to be like, aha, that's the reason why Tattooed Chef is going to do much better than, say, Amy's, for example. Amy's is another frozen brand out there that I see in stores all the time. They make, organic. Many of their products are plant-based, not fully vegan, but mostly vegetarian. Their products are great too. So why Tattooed Chef, right?
That's the thing also, because they do talk a lot about that they're moving on, way beyond the just frozen section, right? They want to be in all parts of the store, basically all kinds of foods, and they have started on that journey now, right? I mean, they coming out with a lot of different products. Last year, I think they had about 7 to 8 SKUs, and now they're planning to have out about 140 SKUs this year, and several of them are not only in the frozen section. And because we should probably also mention that, yeah, they're talking about 10 to 12% margin, continuing to have that this year as well. That is what I've understood. That's standard for frozen food companies, considering the shipping and the kind of technology they need to have in the trucks to keep food frozen. That's going to keep pushing down those margins, right? Either way in them. But if they move on into other products, well, then obviously, hopefully, if they sell as well as the frozen products, or maybe do even better, then we could see those margins coming up. But that's a lot of ifs.
Exactly, it's a lot of ifs. Like what they're trying to do is go for building a brand, an iconic brand that people can identify and relate to, and that's what helps sell. Because at the product level, there's not enough differentiation. Like I can say very easily why Beyond Meat, for example, is differentiated from most other plant-based meats out there because of taste, but also because of manufacturing excellence. So Beyond Meat can do volumes that not many other plant-based meats can do at gross margins that not many others can do.
Right.
So I can't say, so that's the reason why Beyond Meat makes sense as a long-term investment. And of course, they're also attacking a gigantic total addressable market with a product that's differentiated enough from, animal-based meats. Whereas Tattooed Chef, I feel like that is a product that's made for, or at least appeals to mostly vegans and vegetarians right now.
Yeah.
we would need a seismic shift in consumer sentiment and consumer tastes for them to start going towards vegetarian foods. Which could happen, but that's going to require significant re-education of people.
Yeah.
Um, so that applies to Beyond Meat too, by the way. So that's not unique to Tattooed Chef or Beyond Meat, but at least they're making Beyond Meat is making a product that is aiming to be as close to the taste and texture of animal meat as possible, and achieving price parity with animal meat. So that gives people at least some incentive to say, all right, fine, I'll try that. But it's hard to get people to just go out of meat entirely into pure vegetarian or vegan dishes.
Yeah, but that could maybe be the strength, because I've been, as like you, I'm a vegan as well, and that's been one of the things that I found very skeptical with Tattoo Chef, because I feel like it's might confuse people in the future, and also that it's kind of like woke washing, that they keep talking about their products being healthier, keep talking about that they're better for the environment and sustainability, yet you still have like over 50% of their products with a lot of cheese, and there's I think eggs in some of them. There's dairy in it. And that might confuse the market in the long term, and that you won't respect them for that. But I actually liked what Matt Williams said in an interview that when he answered my questions now in the weekend, where he said that not everyone is going to go vegan directly or plant-based, and this could be like a halfway point there, right? That maybe you're not ready to just eat vegan food, but if you try some really good vegetarian food with cheeses that you really enjoy and like, then down the line, they could make that choice. And not everyone is going to go vegan anyhow, right? So, it's still better than not, than continuing to just eat meat, right? If you have alternatives out there, I think to each his own. We have to move from different directions. But actually, I did enjoy what he said. I don't know what you feel about that. Because when it comes to Beyond Meat, there's no halfway there. You're all vegan there when you, or it's an all vegan product.
Mm-hmm. Yeah, exactly. And that's why, yes, there is a trend overall globally that there is a growing interest in going plant based.
Yeah.
And Tattooed Chef doesn't have to, we don't need to get 100% conversion of the world to plant-based meats for plant-based companies overall to succeed. The thing about Tattooed Chef that constantly trips me up is not enough product differentiation from the dozens and maybe even hundreds of other plant-based and branded food products out there. So that's why I always come back to the opposite side of the other side of the equation, which is, if you don't have a product that is significantly differentiated, then you have to do two things. You have to achieve two things in order to be successful. One is you have to have a iconic brand, right, that people identify with and say, yeah, Pepsi is good too, but I like Coke. Or the local branded cola is fine, but I want to buy a Coke because I see the brand and I know what Coke is. But Coke as a product is not that differentiated from other colas out there. There's hundreds of colas, right? Coke's taste might be different, but I'm sure people would get used to anyone else's cola as well, right?
Right.
But the brand sticks out. So that's the reason why people stick to Coke. But then there's also a second part of that, which is that they have the most efficient manufacturing on the planet when it comes to colas. Maybe Pepsi comes close to that, right? So on a manufacturing standpoint, their gross margins are unbeatable in cola, right? They have, bottling, they have manufacturing down to a science. It's incredible how efficient they are, right? So that's what Tattooed Chef needs to do to be successful. They need to have continued revenue growth at a very high clip, driven by a brand that people choose over other brands, and they need to have operational excellence,
Yeah.
which is gross margins that no one else can do. Now they're guiding for gross margins to be somewhere in the 25 to 30% range. Um, and that's in part because of these investments that they're making in automation. So maybe that might help. But I just took a look at a few, food companies out there. For example, there's a company called J&J Snack Foods, right? They're, a very standard, not plant-based, but, very standard, very iconic company that makes, pretzels, and they own this IC brand. If you can see my screen here. So people know those brands, right? They're in amusement parks and, state fairs and things like that. So they own all these brands of snacks, and they do gross margins of right around 25, 26%.
Right.
So, Tattooed Chef is basically guiding for gross margins that, existing established brands already have.
Yeah.
Now, this is not plant-based, so their claim is that, okay, well, plant-based gross margins of 25 to 30%. Does anyone really do that? Maybe not. But again, there's nothing here that's jumping out at me that's saying that Tattooed Chef will be this massive windfall in the next 5 or 10 years.
No.
From either a product differentiation standpoint, a brand standpoint, or an operational efficiency standpoint.
But what when it comes to innovation, because a lot of people, also a lot of YouTubers, and they talk about it a lot themselves about innovation, right? That they're extremely innovative. That now they're out with 140 products, or going to have 140 products, and they talk about innovation in that way a lot. And I've had a lot of arguments with people, or not arguments, but discussions, I would say, regarding what I consider innovation. And it seems to be a kind of hard definition with that. But for me, because I actually I think long term, I do see this company having a place for sure. And I think they could do really well because they are in a trending period, a paradigm shift, and and they're trendy in the way they function themselves as well, right? But I keep wondering when people they shouldn't really be compared to Beyond Meat anyhow, because they're different companies at the moment, anyways. But I don't see them as being more innovative than Beyond Meat, considering what Beyond Meat, the kind of research and science that they're putting behind it, and the kind of R&D they are actually putting into their products, right? Whilst for me, just throwing out a lot of products all the time doesn't necessarily mean innovation, that you're putting together like different dishes with some spices and sauces. And I'm sure a lot of their products are good. You said so yourself. I haven't tried them because they don't exist here in Sweden, and I think in Europe, basically no one knows about them. But what's your idea of innovation, or if you would, say some thoughts about that?
Yeah, no, I think it's great. You can have innovation in R&D, but also have innovation in just new ideas or new takes on food, right? There's billions of, variations of food that we can make, right? Food is such a diverse thing. And, if they can pull it off with regards to taste, or just, unique things that people really, really like that no one else does, right? Yeah. Like the Buddha bowl, or, these other creations that they've come up with, which is great, right? Cauliflower crust cheese pizza, again, if they're able to pull off dishes that just simply aren't available elsewhere, and that people say, I need to have this over anything else that's available, that could be one way that they could succeed. But I see there's many companies that do this, right? There's other companies that also have these types of product, maybe not this exact same, item, like, cauliflower mac and cheese bowl, or, plant-based burrito bowl. Maybe they don't have the exact same thing, but there are, parallels to that, right? Other companies that do that, like for example, Amy's is the one that keeps coming to mind for me. They have these types of frozen, prepared foods as well. And so like that's why they're trying to get into the dry foods market. Like now since they bought this confectionery, they're getting into making plant-based bars now. But again, that's also an extremely crowded market,
Yeah.
right? There's so many bars, hundreds and hundreds of different types of bars that are available. So, unless if they have come up with something that is truly different in taste, that you just can't get anywhere else, it's hard to really make a place. And I agree with what you said, though. I think Tattooed Chef has a place in the world. I think they will, I think they will succeed. I just don't think that this would be a successful investment. That's just my view so far. Unless if they can show that they can do all of this great stuff that they do with, on margins that are significantly better than everyone else out there.
Right.
That's the theory with Oatly and with Beyond Meat, I believe. Both of those companies, have the best product within, the segment that they operate in. That's just in my opinion, but it seems like a lot of people agree with that. But also from the operational standpoint, they will have better margins than everyone else that does what they do.
Yeah.
And lastly, the brand. So they've got all three, in my view, to be a successful company.
Yeah.
They've got, the brand appeal, right? When people think of oat milk, most people think Oatly, at least in Europe. That hasn't yet happened in the US, but I think it will. When people think plant-based meats, most people think Beyond Meat. Maybe they might think Impossible. So it's just a battle between those two, not many else. When you think of frozen dinners or, plant-based dinners, is Tattooed Chef the first one that comes to people's minds? I don't know. If it is, that would be very, very good. That would satisfy the first sort of plank of the investment thesis.
I've actually talked about that when you look at the Google Trends anyways. I don't know if you can trust that with everything, of course, but if you look at Google Trends and just look at the food companies, and you look at Oatly, you look at Beyond Meat as brands, and they're extremely popular when you look at brands, how much they've grown over the last couple of years. And then you compare them to Tattoo Chef. What I've seen I think it was a couple of months ago. Then Tattoo Chef barely registers, right, as a branded name. But then when you compare them to looking at YouTube and TTCF and OTLY and BYND, then off and on TTCF seems popular. So it seems like it's very popular as a stock. But just because a stock is popular among some investors on YouTube, it doesn't translate to more sales automatically, right? And I think it's important for people to understand that.
Yeah, exactly. And, and lastly, like, again, I think the company will do fine, right? They're actually guiding for profitability in the second half of 2023.
Yep.
Which would be amazing, because even Beyond Meat has not guided for that. So that would be awesome if they can do that. But I think because Tattooed Chef is not differentiated in terms of margins.
Not yet.
Since they're not differentiated enough in terms of margins or in terms of, just the maximum size that they could one day become, they're not going to command a very high multiple. So even if they've achieved profitability, I think the multiple on on those profits are going to be basically in line with the industry average, plus maybe a little bit more, because they have 20-30% growth. So I just did a little valuation exercise. As of today, the price is $11.55. The most recent shares outstanding is 82.15 million shares. They've got about 7 million in total debt. They've got 92 million in cash. So their enterprise value today is about $863 million. And their 2022 revenue guide is about $280 million.
Yeah.
And their gross margin guide is 10%. So they're trading at an enterprise value to gross profit multiple of 30 times right now, which is high. I mean, that's very high for a food company. Even if they're growing at 30-40%, that's still very high. I've been talking about this for some time now, but I believe, because we've lived through this incredible bubble period in stocks, the multiples that we saw in 2020 and 2021 are not going to be sustainable. That's why we've seen Beyond Meat, crash. We've seen Oatly crash. We've seen countless other stocks crash. Basically, the entire ARK ETF, all the companies within that, like Teladoc and Roku and everybody, not just plant-based companies, but all companies that had high growth rates and achieved very high multiples, they've all come down. And I think there's still a lot of downside for Tattooed Chef, just because this multiple of 30 times enterprise value to gross profit is very high for a food company, unless if you're growing at 70-80%, right? Maybe more than that. Yeah. And they're not growing at those rates. So, to me, this is telling me that, the growth is good, but they're not going to grow. They're not going to command a significant market share of the total plant-based food market, because they're one among many players within the market.
Right.
So I see the multiple, contracting to 8 times. So even if you were to, grow their, 2022 revenue guide by 30% per year for 4 years, by 2025, you could see them generating $800 million of revenue, versus 280 this year. And even if you believe them on their 25% gross profit margin, I think that the multiple will ultimately converge down to an 8 times, multiple on EV to GP. That gives you a 2025 enterprise value of roughly 1.6 billion. So that's about an 85% return from today's price. And that's assuming a lot of execution. That's assuming 30% growth for 4 years straight, and getting to that 25% gross margin.
So that's not even a doubling of the current stock price, and not that long ago it was up at around $25. It's been up to 28, 29, and that's years away from now, basically, in your understanding of the company.
Yeah, exactly. Remember, Oatly right now trades at roughly 9 times gross profit. So, we're talking about Oatly, which has had 50% growth, and are continuing to have 50% growth, going forward. They're building total of 9 factories globally, and are going to get to gross margins of 40% in the next 2 to 3 years, right? So, a much stronger company with a much stronger brand recognition.
And much older. It's 3 decades old.
Yeah, exactly. And they're getting a multiple of 9. So, 8 could be even high for Tattooed Chef. It might come down to 6. If it does, then, the returns are just not that great. So you would really need to see just incredible growth to be able to justify today's valuation and earn a decent return on your investment.
Yeah.
So if I were to change this estimate to 50% growth, that would start to make sense, right? You'd be looking at basically a tripling from the current price in the next 4 years.
Yeah.
Can they grow at 50% every year for the next 4 years? Maybe. I don't think. I don't know. So these are just questions that I would pose to the audience. Do you think that if they can grow at 50%, then you might triple your money in the next 4 to 5 years?
Which is not bad. And even when you think about it, it's maybe this whole YouTube era of investing in stocks. So many of us are like, I had to change my mind also because I'm a fairly new investor myself. I've only been doing this for a couple of years, and the more books I read, the more you and I talk, and I talk to other investors on a regular basis now who've been doing this for 20, 30 years. And I realized this, 5xing or 10xing in a few years, it's extremely rare. And not every company is a Tesla. And if that's going to be a possibility, you definitely have to be, you have to have a moat. You have to have something different, and you have to have a lot of R&D behind it, probably, and a lot of possibility. And you have to be able to reach some form of economy of scale and have facilities everywhere, basically. And then you have to be profitable, usually quite early on. If you look at the 100 baggers, a lot of people have been talking about 100 baggers and relating it to Tattoo Chef. And in many ways, a lot of our companies that we talk about today, they aren't actually the role model for 100 baggers at the moment, or not even 10 baggers. So we have to realize, if it is that they actually grow 85% in stock price in 3-4 years, realistically, that's not a bad deal when you think about it. So, but if that's not what you're looking for, obviously you need to rethink your idea. But this, obviously, guys, I want you to understand, we're just trying to talk about another picture that might have been portrayed regarding Tattoo Chef, and just having a nuanced perspective, right? I think it's important to just think about that. So,
So keep in mind, the other thing too is that what's happening here is that growth can be achieved in two ways. Either they're getting increasing velocity per SKU, or increasing revenue per SKU, or they're simply entering new SKUs. So this is one of the problems with Beyond Meat right now. So Beyond Meat is guiding for 25% revenue growth this year. But they have to continuously get into new products to do that, because their retail sales are so bad right now, right? Retail sales were negative, deeply negative in the US. So they have to get into new geographies. They have to get into new channels. They have to get into new products entirely to generate that 25% revenue guidance that they're giving.
Yeah.
Which is not a good thing to see. You want to see growth in each of their categories. So they doubled their SKUs, right? So I'm talking about for Tattooed Chef, right? They went from 38 to 78.
Yeah.
So that's a doubling, right? But they only achieved 40% revenue growth for the year, right? So basically, their revenue growth is coming from just introducing more products into the market, not necessarily from increasing revenue per SKU.
Yeah, their goal is to have about 30 SKUs in the larger retail stores, right? So that they're basically having 30 products in the same store, and that's what all the big food companies usually do, right? Or 30, 40, 50. But obviously they're not there yet. They have like between 20 to 25 SKUs in the Targets. But when you really look around in Target stores, it doesn't mean it's like that in all of the Targets. But I think it's also, they're supposed to have about 140 SKUs now this year, right? And obviously that's impressive in many ways. I mean, they are productive, that's for sure. Sarah is productive, the actual chef. But you have to remember that about 80% of their revenue, well, this is about a half a year ago. I haven't heard them saying any more details about that, so I gotta believe that's the same thing now. 80% of their revenue is only from 20% of their SKUs. Mm-hmm. So basically, 80% of their SKUs aren't selling that much.
Right.
So something to keep in mind too. And I do believe it's probably their pizzas that seem very popular, maybe their acai bowls, but it's still hard. We need more information, of course, before we can conclude anything there.
Yeah. Yeah, exactly. So, I'd love to see them, like, it would be great if they could, differentiate themselves, not just based on their creations, right? Which is obviously very important. But I would love to see them announce more such projects like they mentioned. This line right here: commenced enterprise-wide investments in automation, internal R&D, cold storage to support anticipated growth and drive efficiencies beginning in 2022.
No.
I would love to see them like be one of the first plant-based food companies to go, you know, majority automated.
Like kind of Tesla and the plant-based scene.
Exactly.
Mm.
Yeah. Be the Tesla of plant-based food. That would be awesome. Because then that would tell me that, okay, there's something different about the margin profile of this company.
Yeah.
This is what this little company called Lemonade Insurance. A lot of YouTubers like that one too. Um, so Lemonade is kind of their claim to fame is they're an insurance company, right? There's hundreds and hundreds of insurance companies out there, so they don't do much different from. It's just another insurance company. But why are they unique? It's because of their appeal, like their brand, right? If you go to their website, it's super simple. It's you answer 5 or 10 questions and they give you a quote, for insurance. Super easy to use. So it appeals to millennials, right? But that's not enough. So on the back end, they have everything that's automated. So they shared a statistic that showed that, for every customer that they have, paying customer, they've got very, very few employees. Like, so their employee to customer count is extremely low. So they only have like 500 people entirely, working for them for this company that supports over 1.4 million paying customers of insurance. So their claim to fame is automation, right? They have software and algorithms that basically automate everything from signing up to get a quote to filing a claim to getting your claim paid. 90 or so percent of all of that is automated. So they don't need any human being to do that.
Yeah.
That's kind of cool to see. So if they can appeal to millennials and Gen Z kids to buy insurance from them, they don't need a huge chunk of the pie. They could just get a 0.5% or 1% of the total insurance market and be enormously profitable.
Right.
So that's one thing. So if Tattooed Chef can be something like that, where our food creations are what our customers love, but then on the back end we also can generate industry leading gross margins.
Yeah.
They came out and said that would be something that would get me excited, because
Right.
that would create a differentiation.
Yeah. So I guess what someone here talked about is that they have way bigger addressable market, and I think they mean because they're moving in now to other things than frozen section. But we have to understand, of course, they have to prove that first, right? And we have very little to go on that at the moment, but it does seem interesting, and I think that's part of it. What really appeals to a lot of investors out there.
Mm-hmm. Yeah, the total addressable market is massive, right? We're talking about food, right? So it's huge. The question is, what kind of market share can they get in that total addressable market?
Yeah.
Given the fact that we have many, many options in frozen foods as well as in dry packaged foods.
Yeah. So, and I guess one of them or a couple of actually asked, like, if you compare Tattoo Chef, Beyond, and Oatly, which will be the best in the next couple of years. I think we've answered it to some extent, but I mean, you could do a quick rundown. What you feel there?
Yeah, I go back and forth. Right now, it seems Oatly is the number one plant-based stock out there, and probably the best, overall food company out there. I don't know of anyone else that's growing as fast as Oatly in the food industry.
And being that big.
And that big, right?
Yeah.
They're
Yeah.
nearly 1 billion in revenue this
Yeah.
year,
Yeah.
almost. So that's huge, and I see some pretty good execution. There's been some delays, but I think it's just a short-term hiccup. So Oatly is going to be, in my view, the best. But the only downside I see to Oatly is that there's very low barriers to entry in the oat milk market, right? And right now, Planet Oat is the number one market share leader in the U.S.
Yeah.
Oatly dominates Europe, but here in the U.S., Planet Oat is number one. So I think Oatly will take over Planet Oat too once they get their facilities up and running at full speed. So there's that. There's the brand, the viral marketing, the fact that they have a partnership with Starbucks. That's huge. I think because of Starbucks, people are going to get, introduced to oat milk. And when they search oat milk, they're going to see, hopefully if Oatly is the number one market share leader, they're going to see that and they're going to be attracted to the brand. And ultimately, when they try oat milk, I think they will say that Oatly is the best tasting and the most versatile.
Yeah.
So, Oatly is awesome. Beyond Meat is right now in a difficult spot, but I do think that they will succeed. And if they succeed, they have a stronger moat, in my view, than Oatly. So it's this give and take right now. Oatly is much better, faster growth, easier, simpler company, much less R&D needed. It's leaner, faster growing. But Beyond Meat has a much stronger R&D mode. So not many people can do what Beyond Meat does, right? There's many other plant-based meats out there. I think only two have any sort of wide appeal to the bigger TAM, which is people that actually eat meat.
So I'm guessing
much bigger TAM.
And I'm guessing so that to some extent, Oatly's moat right now would be their branding and their fast, trying to reach, getting out a lot of facilities out there, trying to get to that economy of scale. And that's what I guess Tattoo Chef investors have been hoping, that the Tattoo Chef brand, the branding is everything, that would be their moat. Because I don't think just pushing out a lot of products would be a moat. In that sense, not comparably anyways. So, but I'm guessing we're not there yet anyways when it comes to Tattoo Chef.
Yeah.
And
Yeah, there has to be that trifecta. There has to, in the food, especially in the food world, you have to have a brand. Like that's what makes people successful. Brands are what drive sales.
Yeah.
Then there's, product itself, right? People have to love your products, right?
Yeah.
There has to be product differentiation. And then there's operational excellence. So on the manufacturing side, you have to show, good gross margins.
Yeah.
So those are the three things that you have to have.
But I think what people, the video is getting longer now than we wanted to, but we're just going to wrap it up soon. But I'm thinking what people have felt when comparing Beyond Meat and Tattoo Chef, just strictly as companies, many people feel that, in the YouTube space anyways, that obviously Tattoo Chef is the better company because they've only existed as a brand since 2017. Beyond Meat has existed, I think, about 12 years now, or 2009 or 2010, something like that. They had about 460 million in revenue. Beyond Meat had, right? And then Tattoo Chef is already about 213, and they actually were expecting to have over 300 this year, but now they have, like most companies, lowered the projections to about 280 million. But then Beyond is probably going to be at around 630 to 640. So then already Beyond is actually moving away when you look at it from a couple of years from now. And then people don't understand, the difference here, that a lot of the money that Beyond has been losing out is partly on R&D. And the amount of R&D, usually maybe between 40 to 50 million a year. And since they've been investing that much in R&D, when they are ready, when they're happy with their product and reaching price parity with meat, at least one of their products within maybe 2.5 years, as Ethan has been mentioning, let's hope, then and also keep reinvesting with their facilities, then they're out. Then they're basically put out all their pieces, and then we get this that we've been talking about, Tesla escape velocity. Which means they will probably just run away when it comes to sales, and compared to a lot of other companies out there. And I'm guessing you have a hard time believing that we could see that kind of escape velocity right now with Tattoo Chef. Even though it does look good. If they would have about 700 to 800 million in 2025, that is not bad. That's good. And I know that I think Jeremy and the company themselves have been talking about reaching that 1 billion in 2026.
Yeah.
So about 4 years from now. So, but like most companies today, they have had a lot of high hopes and a lot of projections that they haven't actually reached that.
Hmm. Yeah, it'd be interesting. I mean, maybe there's a different approach to like Tattoo Chef's business model that we aren't even considering right now. What if food in retail is not the end all, or the ultimate for where they want to go, right? Since these guys specialize in food creations, right, rather than food ingredients. Beyond Meat and Oatly are more food ingredients, whereas Tattooed Chef is a finalized product, right,
Yeah.
that you sit down and consume.
Yeah.
So maybe they could get into bigger food distributors, right? Like making food for like large food service companies, like the companies that supply hospitals and schools.
As a private label or like white label?
Yeah, as a white label,
Okay.
right? Maybe volume is the way to go. Even if the gross margins aren't there, maybe they make up for it with volume. That's
Yeah.
fine too,
And
right? I
efficiency.
don't exactly, yeah. If you just make things in bulk, even if you do 15% gross margins on it, that could be revenue in the billions, because
Yeah.
there is an increased awareness and demand for plant-based foods.
Yeah.
But people don't want to necessarily go to the store and buy it. They want to be served it, right? So maybe if it's just served to them very easily and accessibly wherever they are located, like New York City, for example, they have meatless Mondays now. So all New York City school kids are being served vegetarian meals on
Yeah.
Mondays now.
Yeah. So
Maybe Tattooed Chef could sign a contract with the city of New York and be the supplier of a plant-based meal for
yeah,
all the kids, and they would
exactly.
love that. That could be an option too that they could, I think they could do. So when you start to think about other avenues of revenue growth, that could be where things get really interesting.
Yeah. Definitely, definitely. And I think there are other things that we could have talked about, but I think we could make a shorter video in the future when it comes to just comparing financials and things like that. Because on paper, I would think when you just look at the financials, to some extent, I think Tattoo Chef probably looks more appealing than Beyond Meat, for instance, because I mean they still basically have no debt. I think like 700,000 in debt. And they have about 95 million left in their free cash flow, and they're going to use a lot of that this year. But according to the CFO, they can probably run another couple of years without actually having to dilute or taking on more debt. So
That's one of the biggest takeaways is
yeah,
that they have sufficient cash, and they're guiding for profitability in the second half of 2023. So if they achieve that, they may never need to do another capital raise ever again. They could
no.
be self-funding.
So that is actually, and that is true. Then I know some people have been talking about that in, I don't know, 5, 10 years, 15 years. It could be a dividend company, like most food stocks out there is.
Yeah.
Yes.
If they just, if their growth kind of tapers off and, they're just becoming a cash cow,
Yeah.
that could be a dividend play,
Yeah, definitely.
So yeah, that could happen.
Yeah. All right, guys. So this is basically what we had to say. We were always planning for making shorter videos, but this is the first time that Mayur and me together talking about Tattoo Chef, right? So so we had a lot to go through. Obviously, there's a lot more to go through. And like I said in the beginning of the video, folks, Mayur hasn't been part of this background. He hasn't followed the growth story for 1.5 years, right? So there might be parts that he is missing, of course, some details, but I don't think that necessarily right now needs to be only negative, right? We need those nuanced perspectives. We need to understand the numbers, and we need to see something else from people who aren't maybe emotionally invested, like me and Mayur are talking about when it comes to especially Beyond Meat. Both him and me, we've also been emotionally invested there. We're not too thrilled maybe today with when we went in with our investments. I think we're around 135, 140 was our average. So in that way, it's an easier way to analyze the company right now, right? So, but that again, that was it for today, guys. And guys, if you want to talk more with me or Mayur, join our free Discord channel down below. And where we talk about Tattoo Chef, we talk about Beyond Meat, Oatly, very good food company. So, and feel free also to, I can show you here, guys, that Mayur, here is his site here on Twitter. Has about 16,000 followers. I think he's added like 3,000 followers in just a few months. Going quickly here. Has a lot to say when it comes to Beyond Meat. He talks about Oatly. He talks about Tesla. T-Doc, right?
Yeah.
So he's open about his investments. So if you want to join him, talk with him, join him on Twitter here. All right, guys, that's basically it for today. Thank you, and thank you, Mayur, for today.
All right, sounds good. See you next time.
All right, peace out.